Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I'm going to be taking a look at Amazon stock, ticker AMZN. This one came in by request a while back down in the comments section of one of my other videos. I got the ticker up on the whiteboard behind me and we're just getting to it now. If you have a request you'd like me to take a look at, just put it down in the comments section. I'll reply and let you know when I get it up on the board here, and eventually I'll make a video. If it's a stock that's in the S&P 500 like Amazon, I post those on YouTube for free. The rest I post over on Patreon at the $5 a month tier level. I also have a new service over on Patreon where each week I share a stock idea. A lot of times in my videos, you'll notice that my buy prices are quite low. I often get feedback that they will never hit, and I'm expecting too low of a price to come. But usually I do buy quite a few stocks. But one of my in the full Cyclical Investors Club service on Seeking Alpha, that's really what we try to do. We try to buy things when there's a big margin of safety or a lot of growth potential or some combination of those two. And I try to be patient and get the best deals I can. But there are a lot of people who are continuously contributing to their retirement funds, or who don't want to sit around on cash and just want to find the best deal possible. So that $25 tier Patreon level is those weekly picks are what that is for. All I'm trying to do is look at the market at that particular time, at that week, find the best idea that's out there and share it. And I assume that a person's taking about a 0.5% portfolio size position with each one, and no stock is picked more than 4 times. So 2% initial weighting maximum. And so yeah, if you want to check that out, go on over to Patreon. There's a free tier there too if you just want to get all the same videos, plus a few extras that I post here on YouTube. Okay. As always, this is not individual investing advice. It's just how I analyze stocks. And Amazon is a very tricky one for me because, well, there's several different reasons. But one is traditionally I've used like an earnings-based analysis. But because Amazon has traditionally invested a lot of the money they make immediately like back into their business, their true kind of potential never really showed up in earnings. And so that always made them look really expensive. Like you go back, let's just look at some of the PEs. Yeah, so 2015, the PE is in 600 or something like that. Still 200. Even going into COVID, it was almost 100. So, and what, this mid of 2018, it was quite high. Let's see, PE 130. Yeah, so it just wasn't a very good metric to use for Amazon. Also, until 10 years ago, we'll say, they were really like a retail-focused business, which was likely to be cyclical. And so it was, pretty, even though they were growing a lot, it was hard to get a read on what a good price would be to buy the stock, because we know that during downturns, earnings can fall a lot with cyclical businesses. So it was just pretty much always been in my too hard category for a long, long time. And the business has really changed since the development of their cloud business, which is when they really started growing earnings and profits. Around, we'll call it 2015-ish, you can see the earnings per share start to grow quite quickly. So it's kind of a different business now than it was for the first, I don't know, when did it go public? 96 or something like that. So for the first 20 years of its business, of its life, it was pretty different than the last 10 or 12 or 15 years. So with that in mind, it's been a very difficult and tricky stock to analyze. But when I went to develop my growth strategy, which is one of the strategies that's in the full Cyclical Investors Club service on Seeking Alpha, I also will use it for the weekly picks on Patreon, but I don't share it on YouTube. But I didn't develop it until 2021. I started working on it in late 2020 and had most of it figured out by late 2021, and then kind of fully worked out the bugs by maybe halfway through 2022. So it's a relatively new strategy for me. But part of it I actually based on Amazon, and how I tried to find a strategy where how would I find a business like Amazon in the early stages before it got big. I looked at Amazon was a good example I wanted to try to figure out, as well as Alphabet/Google, to just see if I could, because basically by the time they would have ever gotten cheap enough in my normal strategy, they would have been very big and I would have had a lot of opportunity cost. Now, if I couldn't, I filter the good ones out from the bad ones, which is always the hard part in the early stages of a growth business. It still might not have been worth it. If you have 12 losers for every big winner, that's just too many. So I did a lot of research to try to figure out some metrics that I could use to help me figure out these earlier stage growth businesses when they were smaller. And I wanted to make sure that whatever I came up with would have worked on Amazon. So because I knew Amazon just totally missed every other method that I had. It just was never going to basically be a buy. And I would say Alphabet's pretty similar too. So I did get that figured out, but there's a little bit of irony here because 2021 was about when I had that all developed by late 2021. And about that time, Amazon's growth actually slowed below the threshold for my growth strategies. So they had already kind of gotten big enough where they weren't going to qualify. There wasn't enough big growth. They weren't growing fast enough, basically. So I couldn't actually apply the strategy I'd used Amazon to create for Amazon anymore. And it still sort of fell in this like limbo land that doesn't fit any of my strategies. And like I said, that happens sometimes. It's not really a big deal. You don't have to get every single stock that comes along. But as you can see, this kind of decline that we had in 2022, mostly with the stock price, I decided that even though I don't have a strategy that fits Amazon perfectly, if I treated it as a deeply cyclical business and used this drawdown as a guide here, as a non-recession kind of drawdown, based on how the market was treating Amazon stock, then I could create some guidelines. So maybe if this happens again, I might be able to pick up a little Amazon stock when it's on sale, even though it's a big company. So it's a little bit more of a mean reversion type of a play, though it could become like a buy and hold if you bought it. Like if you bought down here, you could just kind of buy and hold it until it looked like their business was declining however many years into the future, right? So that was kind of my thinking. I was like, well, I think I can put something together that's like halfway decent, just kind of, muddling together the different ways that I looked at the market. And just so if we get another decline like this one, I can buy a little Amazon and hopefully do well. Because if you would have bought down here, you would have made 100% on the recovery. That's very similar to like a deep cyclical business. And we do see earnings fell here too, but earnings are so hard to quite get a clear read on with Amazon, as I talked about earlier, that this is really mostly going to be about the stock price, because we know they have a great management. We know they have tons of data on everybody, and they're probably not going to screw anything up too badly. So it's really just a valuation thing. I mean, it trades at a 40 PE, but and just saying, okay, well, if I buy it when it's a certain percentage off its highs, I'm probably going to get a decent deal. It might not be the best thing in town, but it could be a great stock to own too, if you can get it cheap. So that was my thought process behind this. So I went and looked at, and by the way, one of the metrics you can look at for growth businesses, I have other ones, but the revenue growth. So this is 3-year cumulative revenue growth. So, divide that by 3 and it's probably a little lower than that. So that's only like 9% a year, we'll call it, for the past 3 years. For growth businesses, I want this to be over 45%. So that's why it no longer qualifies as like a super fast growth business anymore. And we can get a little bit of an idea on maybe what kind of future growth they have in that 9 to 12% range, maybe, which is still good growth, but it's not. This is a giant company. Obviously, there's only so much that they're probably going to be able to grow going forward from here. So I used that. I did look at their other drawdowns too. So 2000 drawdown, 94%, 2008, 65%, and this is the 2020 drawdown, about 55%. So the way I think about it is, and that 2020 will actually be the 2022 drawdown. The way I think about it is, I don't really think this was like a recessionary drawdown because we didn't really have a full-on recession. So this is kind of like a weak economy. It was a bust coming off the pandemic boom. There were several factors, but it kind of is more like a mid-cycle type drawdown. So the main thing I think to understand is, if we have a real recession, the drawdown will probably be worse, right? So this is kind of the minimum or whatever that I would want, or close to it. And the maximum may be more like 65. I don't know if we can really use 2000. This is such a different company from 2008. But we can say, okay, if it fell a little over 50% in 2022 without any recession, any real recession, we can probably assume if we have a real recession, it's going to be a little bit deeper than that. So my thinking is that if it falls 50%, I'd be willing to come in and buy some of it. So this is the recent high price. This is the multiple that I used to get 50%. And then my expected recession drawdown is more like 65% off its highs. So I can use those estimates to say, look, I admit that I'm not an Amazon business expert, although none of them predicted the 50+% drawdown in 2022. So it's not as though if you are an expert that you're going to really know any more than someone like me that's just looking at how the market's treated it here in the recent past and just kind of extrapolating a little bit from that. Now, obviously, if we saw revenue weakness at a time when the economy was doing fine, that would be a warning sign that you might not want to buy it, that it might have just grown as big as it can grow. But we aren't really in a situation like that yet. I also think, and one of the reasons I'm willing to kind of try to get the stock, even though it's not exactly in my wheelhouse, is that I know it's a great business. So that's not really any question. It's just a matter of what's a reasonable price to pay for it, where I can make the type of returns that I want to make. So that's kind of what I'm trying to do here. So 50% off the highs, that's about $100 a share, and right now it trades at $189. And then obviously if that hits, I'll probably take a position and aim for 65% off the highs. I'll put that calculation in when we get there. That will most likely be in a recession situation. And the main thing there is just to have some cash and don't be afraid if it happens, because it'll be really scary. All the news will be bad everywhere. But I think you could obviously get a high quality business if you can buy it for 1/3 of the peak price and maybe half of what it actually is worth. Because right now it's probably... I know the whole market's trading at like with high expectations, and you can look and see. I mean, we know 2021 was a bubble basically, and we're at those levels again. But we've had 3 years to kind of for Amazon to collect earnings and things like that. So valuation wise, the bubble might not be as bad, but we're definitely not in like I don't think we're in a cheap part of the market. So just knowing how everything else is valued right now, I think the market's probably valuing it similar. And that's pretty expensive, but not crazy given, the price of bonds, the state of the economy, the rates of inflation, Amazon's high quality, all those things. You put all that together, it's not a crazy valuation, but it's high, probably a third overvalued what I would consider like fair value when I look at all the other stocks that are in this category. So I would want to buy that at a discount. So that gets you to like that 50% off the high range. I depend on the market for some of this and just my judgment of how the market's viewing things, because I don't really feel like I can go into the nuts and bolts of Amazon and, break out each segment, figure out what it's all. I mean, I don't think I can do that any better than anybody else, but I think I have a better ability to look at how the market's behaved in the past, understand a little bit why it's thought that way, and then use that as a guide for how the market might behave in the future, and then just accept that. Don't take a giant position, treat it just like all my other positions, and take my 1% portfolio position or 2%, and then just see how it plays out. So it's probably not a super satisfactory analysis of Amazon, but it probably is useful to think about how you can sometimes try to figure out a way for a stock that maybe doesn't fit exactly what you're best at, but you still know is a good business, that you would like to have a little bit in your portfolio without paying too much, even though you're probably not going to be hitting super home runs with it. So just thinking logically, avoiding mistakes, not getting emotionally involved, and just kind of saying, okay, I might be roughly right on this if I can just buy it when it's half price, right? So sometimes it just comes down to those simple things. I've had plenty of stocks where I did that on and they work out better than the ones where I think I'm 1,000% right on sometimes. So, all right, if you found this useful, hit the like button, hit the subscribe button. If you have a request, put it down in the comments. I'll see everybody later. Bye.